The Basics of Finance by Pamela Peterson Drake and Frank J. Fabozzi offers a comprehensive and accessible introduction to the core concepts of finance. The book is designed to help beginners understand how financial markets operate, how businesses manage financial resources, and how investors make decisions about their portfolios. It provides clear explanations and practical examples, covering the fundamental principles that anyone should know in order to build a solid foundation in finance. The book begins by establishing the importance of finance in both personal and business contexts. Finance is described as the study of how money is managed and the process of acquiring funds to invest in projects, ventures, or assets. The authors explain that finance plays a crucial role in making decisions related to the allocation of resources. They also highlight the three main branches of finance: corporate finance, personal finance, and public finance. Corporate finance focuses on business decisions regarding funding and investment. Personal finance is concerned with managing one's own money through budgeting, saving, and investing, while public finance involves government policies and how governments manage their financial resources. In the second chapter, the authors delve into financial markets, which are essential for facilitating the flow of capital between investors and companies. Financial markets play a critical role by enabling businesses to raise funds and by providing investors with opportunities to grow their wealth. The chapter distinguishes between primary and secondary markets. Primary markets are where new securities, such as stocks and bonds, are issued for the first time. Secondary markets are where existing securities are traded, providing liquidity and allowing investors to buy and sell assets. The authors also describe the various financial instruments that are traded in these markets, including stocks, equity securities, bonds, debt securities, and derivatives, financial contracts whose value is based on an underlying asset, such as futures or options. The third chapter focuses on financial statements, which are essential tools for understanding a company's financial health. These statements provide vital information for investors, analysts, and decision-makers. The primary financial statements discussed are the balance sheet, the income statement, and the cash flow statement. The balance sheet lists a company's assets, liabilities, and equity, showing what the company owes, and the value remaining for shareholders. The income statement provides a summary of revenues and expenses over a specific period, ultimately showing the company's net income, profit or loss. The cash flow statement tracks the movement of cash in and out of the company, reflecting its ability to meet financial obligations. The chapter also emphasizes the importance of financial ratios, such as profitability ratios, net profit margin, return on assets. The fourth chapter introduces the time value of money, TVM, which is one of the most fundamental concepts in finance. TVM is based on the principle that money today is worth more than the same amount of money in the future due to its earning potential. The chapter explains how present value, PV, and future value, FV, calculations are used to determine the worth of money at different points in time. Present value refers to the current value of a future cash flow, discounted at a specific interest rate. Future value refers to how much a present cash flow will be worth at a future time, given a particular interest rate. The authors also discuss the concept of discounting, which is used to calculate the present value of future cash flows, and provide formulas for performing these calculations in various financial scenarios. The fifth chapter focuses on risk and return, a key relationship in finance. The authors explain that risk is an inherent part of all financial decisions, and that higher potential returns are generally associated with higher levels of risk. A key aspect of investing is understanding and managing the trade-off between risk and return. The book explains the concept of risk diversification as a strategy to reduce overall portfolio risk. By spreading investments across a variety of assets, investors can reduce the impact of any single investment's volatility. The authors also introduce portfolio theory, which involves balancing different assets to optimize risk and return. Additionally, the chapter discusses asset pricing models, such as the Capital Asset Pricing Model, CAPM, which estimates the expected return of an investment based on its risk in relation to the broader market. In the sixth chapter, the authors discuss capital budgeting, the process by which companies decide which long-term investments to pursue. Capital budgeting is essential because businesses have limited resources and need to make informed decisions about how to allocate capital to different projects. The chapter explains several techniques used to evaluate investment opportunities, including net present value, NPV, internal rate of return, IRR, and payback period. Net present value calculates the difference between the present value of cash inflows and outflows associated with an investment. A positive NPV indicates that the investment is expected to generate value. The internal rate of return is the discount rate that makes the NPV of a project equal to zero. If the IRR exceeds the company's required rate of return, the project is considered a good investment. The payback period measures how long it takes for an investment to recover its initial cost. The final chapter of the book introduces portfolio management, which involves the selection and management of a collection of investments to achieve an investor's financial goals. The chapter explains that the goal of portfolio management is to optimize the return on investment while minimizing risk. One key concept discussed is asset allocation, which refers to the process of deciding how to distribute investments among various asset classes such as stocks, bonds, and real estate. The authors also emphasized the importance of rebalancing a portfolio to maintain the desired asset allocation. Rebalancing involves periodically adjusting the portfolio to ensure that it remains aligned with the investor's financial goals and risk tolerance. In conclusion, The Basics of Finance provides a thorough yet approachable introduction to the principles of finance. The book covers a range of essential topics, including financial markets, financial statements, risk and return, capital budgeting, and portfolio management. Through clear explanations and practical examples, the authors demystify complex concepts and provide readers with the knowledge needed to make informed financial decisions. Whether you are an aspiring investor, business leader, or someone simply interested in finance, this book offers valuable insights into the fundamental principles that govern financial decision-making.